So this next part of today, we're going to talk about metrics, targets, and scenarios. And we're first going to talk a bit about metrics and targets. So as mentioned, this is one of the pillars of the TCFD recommendation. So we mentioned earlier on that we would be going into more detail of this part of the TCFD recommendations, which is around metrics and targets. So as a reminder, the recommendations from TCFD under this pillar says that organizations should disclose the metrics and targets users to assess and manage relevant climate-related risks and opportunities where such information is material. The sub-recommendations here, as a reminder again, firstly is asking organizations to disclose the metrics they use, then disclose Scope 1, Scope 2, and if appropriate, Scope 3 greenhouse gas emissions, as well as the related risks, and then to describe and disclose the targets used by the organization to manage climate-related risks and opportunities, as well as the performance of against those targets. This slide is kind of making it a bit more clear that this last pillar around metrics and targets is talking about firstly metrics, and metrics are quantities that indicate the level of historical, current, and forward-looking climate-related risk and opportunities for the organization. This can be used to track climate-related risk and opportunities and can also be used to measure progress against climate-related targets over the duration of the period for which the target is set. Then the climate-related target. This is a specified level or threshold of the quantity of the metric that the organization wishes to meet. And this is also defined by a time horizon, and it indicates the organization's overall ambition in relation to climate change and their climate-related strategy. Important throughout the TCFD is how these interplay with financial impact. So TCFD as a framework is bringing the climate change and climate science world closer together with the financial world. And in this specific pillar around metric and target, the climate-related financial impact is again important for how the targets and metrics relate to each other. So here, climate-related financial impact, we're talking about a historical or current quantity or forward-looking quantitative outlook or an estimate of the projection or forecast regarding the financial impact of climate-related risks and opportunities on the organization's financial performance or position. Under this target, Scope 1 and Scope 2 and Scope 3 emissions are important. Here we mentioned Scope 1, and we mentioned greenhouse gases earlier in the workshop today. And this slide is going deeper into the concept. So carbon dioxide or CO2, we're quite familiar with and we've mentioned a few times. CH4 is methane. We've also mentioned this. This is quite a powerful greenhouse gas. Nitrous dioxide, hydrofluorocarbons, chlorofluorocarbons, sulfur dioxide, nitrous fluoride. These are all greenhouse gases and are part of the GHG protocol. And it's important to consider the emissions of all of these in your what they call CO2 equivalent. So normally these things get rounded up into carbon dioxide or CO2 equivalent. So for example, I think methane is about 8 times of CO2. So that gets all put together into CO2 equivalent. So you might see CO2e as a metric that's often used, as it encompasses all these greenhouse gas emissions into one kind of metric expressed as parts of carbon. So it's getting a bit complicated here. Hopefully you're still with us, but effectively there are lots of standards, frameworks, protocols for one that can look in and find the more technical directives on how to measure and report on these greenhouse gas emissions. But this slide is showing you in more detail where these scope 1 emissions are coming from. These are from company facilities, company vehicles, from where these scope 2 emissions are coming from, and that's from electricity. And then these scope 3 indirect emissions is coming from that value chain, that procurement, that indirect emissions from things that companies need as inputs into their production processes. And these are important for financial institutions because here you can see right at the end part is the investments. So scope 3 includes the emissions that come through from your investments. There are other metrics that people should consider that are beyond greenhouse gas emissions. And, when full quantitative, that's when numerical information is not available, qualitative disclosures can be used to supplement or act as a proxy for quantitative data. So examples of this in other metrics include the proportion of assets or operating or investing or financing activities that are materially exposed to physical risks, credit or investment exposure to fossil fuel, proportion of assets and or operating, investing or finance activities that's aligned towards climate-related opportunities, the amount or proportion of senior management remuneration that's impacted by climate considerations, and the amount of expenditure or capital investment deployed toward climate risks and opportunities. We've shown some examples throughout this workshop of different companies' disclosures aligned to TCFD. But under the metrics and targets part of today's session, we also wanted to highlight some interesting examples. Here, the slide is showing the disclosures from Liberty Mutual, financial services company. They are disclosing, firstly, their total investments in traditional energy. These are investments in fossil fuels, so coal, oil, natural gas. And here you can see per year it's provided. So historical information is provided to allow for trend analysis. In addition, here Liberty Mutual is disclosing their total investments in alternative energy sources. So these could be things like solar, wind, hydro, or alternative energy sources like concentrated solar power. And here again, historical information is provided to allow for trend analysis. So it's disclosures of investments in sectors that are exposed to to the climate change risks, and investments in sectors that are considered opportunities in the climate change space. So quite an interesting example here from Liberty Mutual. Another example is from Citibank. Here, this graph or this table is showing in more detail Citi's exposure and portfolio to certain sectors that are specifically impacted by climate change risk. And it's showing the percentage of Citi's total portfolio that's exposed to these certain sectors. And it's showing that in a dollar amount as well as percentage amounts. And in the last two columns here, you will see transition risk and physical risk, where a almost qualitative score is given, where the risk exposures are indicated, whether it be high, moderate, or low in terms of Citi's classification to these risks. And further details are given in the disclosures around how these high, moderate, and low scores are created. But this is a good example of TCFD aligned disclosures in terms of metrics that they've put out, as it shows the exposure to sectors that would be affected by climate change. Another really interesting example here is from Barclays, which is a financial institution that's showing their targets that they've set. So here they've set targets for reducing their exposure or allocation to the energy sector, and specifically the sector that is highly exposed to risks from climate change. So here they've got their portfolio target as well as their benchmark, and they show their interim target here, which is a 15% reduction by 2015. They also indicate which year is the baseline, how the index is created. So 2020 would be where they're measuring their reduction from, and they're showing their path, their target path, and their benchmark target as it declines over time. They also give the absolute amount here that was in 2020, which is 75 megatons of CO2. So they want a 50% reduction of that 75 megatons by 2025. So we've seen now disclosures on certain metrics from companies, and here this is a nice example of a company disclosing their targets. They've disclosed their targets in both the risk side of things as well as the opportunities. So here they've also showed finance emissions and emissions intensity. So they've got their kilograms of CO2 per megawatt. They show their target path, and they show their benchmark. This next slide is got some good information and examples on the metrics for measuring finance emissions. We spent some time talking about this under the TCFD pillar for metrics and targets, but it's good to spend a little bit more time on this because it's quite an important element of the TCFD framework and for climate financial disclosures, as well as climate risk management. On the left-hand side in the first column, the metrics are given. So here the metrics that are recommended are absolute emissions, economic emissions, physical emissions, and weighted average carbon intensity. So on the absolute emissions here, the purpose is to understand the climate impacts of loans and investments. And what should be disclosed is here the total greenhouse gas emissions of an asset class or portfolio. So as asset owners, as principal consultants, trustees on retirement funds, one should be looking at the total emissions for an asset class or portfolio within your fund. Economic emissions is to understand how the emissions intensity of different portfolios or parts of the portfolio compare to each other per R1,000,000 or per $1 million, or another monetary unit that is appropriate for your fund. Here, as mentioned previously, absolute emission, the intensity, the metrics are your absolute emissions divided by the loan or investment volume expressed as tons of CO2 per R1,000,000 invested, €1,000,000 or $1 million, depending on the fund. But I think for the audience today, it will all be in rand mounted intensity figures. The physical emissions intensity. So here, to understand the efficiency of a portfolio or parts of a portfolio in terms of total carbon emissions per unit of common input. Now, this might not be 100% relevant to financial institutions or pension funds. This is more related to organizations or industrial manufacturing organizations. But when one is looking deeper into a company and deeper into a portfolio, looking at company level metrics, then one can look at the absolute emissions of a company divided by an output value expressed as, for example, tons of carbon equivalent per megawatt hours if it's an electric company, or tons of carbon per product produced if it's an industrial or manufacturing company. The weighted average carbon intensity. So this is probably more relevant for financial institutions and is a good metric to look at to help understand the portfolio's exposure to carbon intensive companies. So here, the portfolio's exposure to carbon intensive company is weighted and expressed as tons of carbon per R1,000,000 in company revenue, but weighted as your exposure to that company. And to get the total portfolio, you just sum all those up. So your weight of an exposure to a certain company, their carbon intensity, you multiply those two, and then you do that for each company and sum that up to get your total portfolio weighted average carbon intensity. And it's something for you as principal officers, retirement fund trustees to be requesting from your asset managers in order to get a sense of where their positioning is and in relation to carbon emissions and carbon intensity. So this next slide is showing you some good examples of how to translate your metrics into targets. So here on the left-hand side, it's showing you the metrics. So for example, your greenhouse gas emissions, talking about scope 1, scope 2, scope 3 from absolute. And then how can that be translated into a target? So the target here would be to reduce your net scope 1, scope 2, and scope 3 emissions to 0 by 2050, with interim targets to cut emissions by 70% as an example. Again, carbon pricing, this could be an example of a metric, and the target could be to increase shadow carbon pricing to $150 by 2030 to reflect potential changes in policy. So for those who might not be familiar with carbon pricing or shadow pricing, here is where you assign a price to carbon that's not maybe considered in the market. So the company can well say that the current price of carbon, whether it's 0 Rand or 140 Rand per ton, as is the carbon tax, is too low. So you set a price that's probably more in line with best practice and international literature and science. Delving more here into some examples of metrics, we showed some good examples from on the previous slide of companies disclosing their proportion of assets or operating or investing or financing activities that's materially exposed to physical risks. And here again, there's some examples of potential targets that one can use so that to reduce your percentage of asset value that's exposed to acute and chronic physical risk by 50%. So some good examples of reduction in exposure targets there. And then skipping ahead lower down onto the slide, looking at remuneration targets. Here, the remuneration targets could be to increase the amount of senior management remunerations that's impacted by climate considerations. And then the last example of a metric on this slide is showing or discussing about the amount of expenditure or capital investment deployed toward climate risks and opportunities. Here, the target could be invest at least 25% of annual capital expenditure into renewable energy, or to lend at least 10% of the portfolio to projects focused primarily on physical climate risk mitigation. The last slide here on the deep dive into the metrics and targets pillar of the TCFD recommendations is around timelines. So here it shows different timelines from 0 to 2 years to greater than 10 years, so from a short to a medium to a long term. Under the short term, one can look at the financial implications from climate change. So to estimate the actual climate change impacts on current revenues here, or it would be more specifically on returns. Or here you would be looking to your asset managers to ask them how they've estimated the impacts of climate change on the investee companies, the revenues, cost budgets, and the values of assets and liabilities of the underlying companies, and the valuation of assets and liabilities of your pension fund. And these can be short-term, these are for the short term, and the recommendation as well is also asking for asset managers to formulate operating or look at the operating plans and the financial projections of companies that they hold in the evaluation process. Looking onto a more medium-term scenario from 2 to 5 years. here again to project the estimates of potential returns in response to climate change, again to look at project planning, financial analysis, and strategic projects and initiatives. And that's looking over the medium term. Getting into the longer term aspects of your time horizons in the metrics and targets part of targets part, one should look at broad estimates of relative shifts in capital expenditures due to climate change, strategic planning informed by scenarios. And then for the longer term, it's important for a broad conceptualization of possible financial pathways and strategic thinking informed by scenarios. And this is a nice segue into the next part of today's agenda, which is going to be talking about the scenarios and scenario planning as suggested by the TCFD. So thank you. That is my time for today. I will hand over to Adrian, who will take you through to the next part of today's agenda. So thank you all. Adrian, over to you.
Thank you very much, Seren. We really appreciate all of the content that you've shared with us today. And I'm sure that it's been very useful to our workshop participants. And I think metrics and targets is really where the rubber hits the road, especially for corporates and investors. Organizations that don't have metrics and targets, don't really have a plan. And investors want to have that confidence in organizations that they are actually starting to, consider different scenarios on the horizon around climate risk and how they are going to prepare themselves into those possible futures. And so metrics and targets is a very important aspect, as is scenarios as it relates to the TCFD recommendations under the strategy pillar. And so I'm going to be speaking briefly to scenarios as they relate to the TCFD. So as mentioned, scenario analysis forms part of the strategy section of the TCFD's 4 recommendations, specifically to disclose the actual and potential impacts of climate-related risks and opportunities on the organization's businesses, strategy, and financial planning, where such information is material. And scenario analysis is one of those tools in the toolkit for organizations to consider future potential environments in which organizations will find themselves. And that's where the role of scenarios comes to play. So at its simplest, a scenario is describing a path of development leading to a particular outcome. And we do scenario planning in our personal lives every day, thinking about what are we doing for the long weekend. There's various scenarios that can come into play, some of which may happen and some which may not happen. And so scenarios are not intended to represent a full description of the future, but rather to highlight central elements of possible futures and to draw attention to key factors that will drive future development. And this is true when we consider economic scenarios or political scenarios, or scenarios in our personal lives, as well as when it comes to climate risk scenarios. Scenarios are hypothetical. It's a what-if question. It's not a forecast per se, or a prediction, or a sensitivity analysis, but rather, hypothetically speaking, we're considering different futures. Ideally, scenarios should challenge conventional wisdom about the future, so business unusual or future unusual. And scenarios are there to really explore alternatives and alternative options that may alter our business as usual assumptions. And so people like Elon Musk and Tesla or SpaceX, those are great examples where individuals and companies have really challenged the status quo, and they've really pushed the boundaries when it comes to thinking outside of the box and using scenario analysis as a means to get there with scenario analysis informing critical and strategic thinking. So when it comes to scenarios, there are 5 kind of key characteristics that one wants in terms of a scenario analysis, and that is that scenarios should be plausible. So, for example, the events that are depicted in scenarios should be possible, and the narrative of those scenarios should be credible. So, for example, being able to describe, what happened, why, and how it happened should be believable in a plausible scenario environment. Secondly, scenarios should be distinctive. So each scenario should focus on a different combination of the key factors. This means that they need to be clearly differentiated both in structure and in message, and not just variations of a single theme. Multiple scenarios should also be used to explore how different permutations or developments of the same key factors could actually result in different outcomes. And then scenarios need to be consistent. So there needs to be a consistent internal logic for each scenario. Again, the goal of scenario analysis is to explore the way that factors interact and how each action could have a reaction. And neither actors nor external factors should completely overturn the evidence of current trends and positions, unless logical explanations for those changes are a central part of the scenario. And apologies if this is a bit technical. Scenario analysis is for the futurists and the Clem Santas of the world, but we are trying to break it down into easy, manageable theory. Fourthly, scenarios need to be relevant. So for each scenario and the set of scenarios as a whole, they should contribute to specific insights into the future that relate to strategic and or financial implications of climate-related risks and opportunities. So in the context of climate-related scenario analysis, the relevance factor is very important. The scenarios need to interact with and provide insight into the future as it relates specifically to climate risk. Lastly and fifthly, scenarios need to be challenging. They should challenge conventional wisdom and simplistic assumptions about the future. And so when we think about the major sources of uncertainty, scenarios should try to explore alternatives that will significantly alter the basis for business as usual assumptions. So those are the kind of key characteristics of scenarios. And these are more generic characteristics around scenarios. When it comes to climate specific scenario analysis as it relates to scenario analysis per the TCFD framework, again, it's addressing things like both climate transition risk and physical risk. And, we're obviously wanting to limit global warming to as low a temperature increase as possible for as low a resultant environmental impact. And of course, that environmental impact is going to have significant financial and social impacts as well. But it really is underpinned by 2 kind of levers, if you want to call it that. A weak policy response globally around addressing the challenge of climate change is meaning that we are going to be dealing with the costs at a later stage. So the financial impacts may be less severe over the short term because these costs are only going to be borne later. But at the same time, those costs are potentially catastrophic. And so if we have a weaker policy response now, it may be easier in terms of immediate knock-on impacts and effects. But at the same time, if we delay those policy changes, leave them for later, there's going to be more catastrophic or potentially harsher policy changes, which are going to impact on financial and other aspects because of a delayed or a reduced policy response. If we see a stronger policy response up front, it's going to allow us to address transition costs earlier in the process, resulting in those costs being more manageable. And so there's a trade-off. There are trade-offs between a weaker policy response and the climate change impacts, or a stronger policy response and the climate change impacts. And so scenario analysis is really, in terms of climate risk, an opportunity to look at these different variables and to see what is most appropriate. And this is, again, something that is of importance both for investors in considering the future environment or future scenarios into which investors are going to be investing for the future, but at the same time also policy and government, policy setters, policy makers, government regulators, in considering what is most appropriate for a specific country or region or trading bloc, etc. And so the image on the right-hand side of the screen is from the International Investors Group on Climate Change. So this has been around for a while, but effectively just looking at the different possible futures, the different temperature increase scenarios, and what is most likely to be the resultant change based on the kind of policy changes that will be brought about by the likes of these COP meetings of our international heads of state, etc. So at its simplest, scenario analysis as it relates to TCFD is a tool to highlight the key risks and opportunities that investors and policymakers and other stakeholders need to focus on in terms of different expectations for a future reality. And there are different elements to a climate scenario. Firstly, different temperature increases, and obviously the lower the temperature increase, the less of an impact on our global environment and human health and the natural capital. The more extreme the policy response, there will be some immediate financial implications, but at the same time, a weaker policy response over the short term is only pushing out those negative, environmental as well as financial impacts down the line. So here you can see again that it speaks to physical hazards and transition shocks and the different variables, both in terms of quantitative and qualitative financial implications, as well as the resolution of analysis. So for example, what about the underlying instrument or investment or asset? What about security or insurance for such an asset? What about particular sectors or asset classes at greatest risk? And of course, when one considers risk from an investor perspective, you're also looking at country or sovereign or regional risk. And climate risk and climate scenarios are going to factor across all of these elements. Again, companies are also not islands. They are interrelated and interconnected with other organizations and businesses in their value chain. And so, looking at the bottom kind of middle area of that image, in terms of the value stream, there are going to be impacts both in scope around the macro environment, the supply chain, the operations and assets of an entity, as well as its market or market share. And so as a result, it's important to understand the exposure, the sensitivity, and the adaptive capacity of particular entities to some of these climate shocks or transition risks. And using the example again of the global pandemic and the shutdown on the restaurant and hospitality sector, for example, some companies were better positioned to actually adjust and adapt to those shocks to the system. And in a similar vein, in terms of climate risk, both from a physical and a transition risk, companies need to be looking already at their strategy based on different future scenarios around how they can ensure that they are resilient and will be around for the long term.